First, let me thank the Global Interdependence Center for the honor of being inducted into the College of Central Bankers. I'm particularly happy that I'm being inducted with my friend Charlie Plosser. Charlie and I became good friends when we were at the Fed. And in fact, in the Federal Open Market Committee meetings, our seats were right next to each other. And many of you don't know that because the transcripts come out 5 years after the meeting, everyone lives in fear they'll say something stupid. So I have very fond memories of watching Charlie frantically adjust or edit his remarks before his turn came. And then, of course, I would turn to the task at hand, which was frantically editing my remarks before my turn came. So Charlie, it's very nice that we could do this together. I am a great fan of Gary Larson, The Far Side. Some of you remember he retired a few years ago. A cartoonist, Christian, for your benefit, a cartoonist with a very perverted sense of humor in many respects. And I was going through an album of these cartoons a while back, and I came across one which shows a dinosaur convention with Tyrannosaurus Rex standing at a podium, like Charlie and I used to do, and looking down on a convention of dinosaurs, and the caption reads, "Ladies and gentlemen, the future looks bleak. An asteroid has hit, the climate is changing, mammals are taking over the planet, and we have brains the size of a walnut." That's a pretty bleak kind of picture. I am not quite that pessimistic or fatalistic, certainly not. But I have, as a central banker, I learned to worry. That's what central bankers do. I am worried a bit about the policy space that the Fed has now in the event of a serious shock or downturn in the economy. I've been watching this for a while. For one reason is I think once you are no longer in the room making policy, very precise criticism is perhaps not appropriate. I shared a golf cart with Larry Summers a couple of years ago, and Larry Summers is former Treasury Secretary and president of Harvard. He's not a very good golfer. But in the course of 4 hours, he did say something that really stuck with me. And he said, once he left office, he never criticized policy in a precise or specific way, because he said, you simply cannot know what information is in front of the policymaker in the room making decisions. So he said, speaking for himself, said, I keep my commentary at a strategic level. And I think that makes a great deal of sense. The context in which today's Fed is making policy, I think, has evolved over the last several years. And I would argue that in the current circumstances, it is a tight context. There's not as much policy space as maybe the Fed enjoyed in earlier years. Charlie and I came into the Federal Reserve before the crisis, and I came in just before the crisis in March of 2007. In a lot of circles of financial people, that always evokes chuckles. You're the guy who caused all this. And the policy space, if you think of it at that time, was pretty comfortable. The federal funds rate was at 5.25% when I joined the Fed, so you had a relatively high policy rate. The balance sheet was really quite simple in those days. It was about $800 or $900 billion, and on the asset side, it was almost entirely treasuries, and on the liability side, it was currency in circulation and a very small quantity of reserves, quite different from today. So when the crisis hit, there was, in fact, policy maneuverability or space in which to operate. That led into the crisis phase in which within a calendar year, or a little more than a calendar year, starting from the fall of 2007 to December 2008, the federal funds rate was dropped 5.25%, basically to zero, the zero lower bound. And that was a remarkable action when you think of how rapidly the Fed brought down, the FOMC brought down the policy rate. That then led to the next phase, which was a recovery phase, with the policy rate at basically zero, the economy needing, because of recession and ultimate recovery, needing more accommodation. The FOMC resorted to quantitative easing or large-scale asset purchases. And the balance sheet grew from about 800 or 900 billion to 4.5 trillion. And in theory, you can go, as Charlie talked about earlier, and this, of course, is probably a major risk, that you can grow the balance sheet unconstrained. So in a certain respect, there was a great deal of policy space for quantitative easing. It was a question of where it was going to stop. That phase lasted for several years until I would argue a third phase came along, and that phase was the normalization phase. It began in December of 2015 when liftoff was voted by the Federal Open Market Committee. And then somewhat after that, the balance sheet was stabilized, the quantitative easing was curtailed, and then the balance sheet gradually began to shrink as runoff basically drove the scale of the balance sheet and ultimately reserves. I would argue that that phase, in terms of policy space, again was reasonably benign at the time, because when you're raising rates, normalizing interest rates, you have some upside potential, whereas on the downside, of course, the zero bound or the as low as you can go is going to constrain what you can do if conditions require that. Over the 2019, I think a set of circumstances have coalesced. As I said earlier, that constrain or potentially constrain the FOMC in reaction to a serious set of developments sometime in the future. And what are some of those conditions or circumstances? Well, first, we're enjoying moderate but on balance relatively low growth in an environment, a world environment, in which growth is really quite modest. The low growth is accompanied by an interest rate environment, again globally, that is low by almost any set of standards. The policy rate, both around the world and here in the United States, is set at not a historically low level, because it was once at zero, but in the environment of a stabilized economy and full employment, a low level. The neutral rate, and I think most of you know what that is, it's a rate at which you're neither adding stimulus nor tightening. It's sometimes called an equilibrium rate. It's also a rate, one definition is it's the rate that would sustain an economy in which both of the objectives and the dual mandate have been achieved. The neutral rate has declined over the last 7 years from 4.25% to 2.5%, as indicated by the FOMC's long-term projections for that. I think that's important and meaningful. 2 weeks ago, Governor Brainerd gave a speech. She mentioned that basic statistic that's over 7 years. We've seen the neutral rate decline from 4.25 to 2.5, and she called that striking. And I would tend to agree with that. We are in a world where the basal metabolic rate of the economy has simply declined. So those are some of the conditions that are defining, I think, the amount of policy space that the FOMC enjoys. And what are the implications of this picture that I've painted? Well, first, thankfully, the FOMC is spending a great deal of time thinking about planning for its playbook in the event that there is a serious downturn or a shock to the economy, something that would require moving in the direction of the zero lower bound. The thought process is the economy currently is performing well, but a recession, most economists say a recession, we haven't immunized ourselves from recession, so a recession is inevitable sooner or later, and the Fed needs to be ready. And if it's starting from a 1.5% policy rate, you're much closer to zero, and you have to be thinking about the playbook that you would have at a zero policy rate. The tools are limited, in my view. The basic tools are cut rates, quantitative easing or large-scale asset purchases, maybe some form of yield curve management, forward guidance, in which essentially you're using communication as a real form of policy to try to shape the evolution of the economy, largely through the expectations channel of the public or the financial market. There are a couple of other tools that have been deployed around the world. One is negative policy rates and negative interest rates. It's viewed as very unlikely to occur in the United States because it would be probably a bad judgment to do it given the structure of the financial industry in the United States. And the second is a theoretical helicopter money. One way to think about that is and the Fed would print it, and the political, the politicians would hand it out. This is Andrew Yang's freedom dividend, if you will, quite literally sending money to people to try to get spending going and demand going. Both I consider extremely unlikely. So the playbook, and maybe Pat Parker will say there are some ideas at work here that I haven't read or heard about, but the playbook is somewhat, I think, limited. And there is concern, discussion of the potency of the tools that the Fed actually has. Cutting rates, there are 6 25 basis points rate cuts before you're zero. That's not very many in response to a serious downturn of some kind. It may very well be that the U.S. economy is no longer all that rate sensitive. Cutting rates may not have a strong reaction in terms of stimulating greater demand, stimulating activity. In the last minutes, the October minutes of the FOMC, it was mentioned that at least some participants in the meeting expressed the view that using quantitative easing to try to suppress long-term rates or medium to long-term rates may not be all that powerful in terms of ultimate stimulus starting at a low point. Today, the 10-year Treasury is at about 180, roughly. So if you're starting at that point, trying to suppress long-term rates may not have so much effect. So limited tools, to some extent, questions about the potency of those tools. Those are two implications. I would say another implication is the relatively new tendency or the view that policy has to be prepared to act soon, a preemptive bias. And that is simply because you don't have a lot of room between that here and zero. I view that as having some risk of false positives that can develop. And let me give you an example. For some, but not all of the recent years, going back, say, 6 or 7 years, the first quarter was curiously a weak quarter. It didn't seem to be in the cards at the end of the fourth quarter, and yet the first quarter came in weak, and it put the committee in a position of trying to interpret whether that was something that you would look through and ignore and expect a rebound in the second, third, and fourth quarter, or whether it was something to act on. In the current circumstances, where it appears that the FOMC is on hold and has set a high bar for reaction, I doubt that there's going to be much of a move over, in terms of policy over the coming year. But if the first quarter is unusually weak for some reason, it will create that very tricky situation of how do we interpret the data under those circumstances. And I'd also argue that there is some tension between data dependence as a doctrine, an appropriate doctrine for setting policy, and a posture of preemption, a tendency to want to act early to avoid a free fall down to zero lower bound. Communication is always important, but will continue to be, or maybe even more so be, an important tool under this set of circumstances. Communication in two forms. One, as I already mentioned, one policy tool is for guidance, in which the FOMC talks in terms of a commitment for a period of time or some set of conditions that would have to be met before there would be a change in policy, something along those lines. But more generally, if the Federal Reserve has to resort to communications to try to shape the evolution of the economy by, as I said earlier, through the expectations channel or whatever, there is going to be a premium on effectiveness. Now, there has been some experimentation and some innovation in communication over the last few years. That has not gone as far as the Bank of Jamaica. The Bank of Jamaica has actually commissioned reggae songs with monetary themes. So if you can, the imagination runs wild. If you can imagine Pat Harker strutting across a stage, and apologies here to the Rolling Stones, you know, I can't raise no expectations, and I try, and I try, and I try, hey, hey, hey. Maybe you'll see that. My former colleague, Dave Altig, who is a board member, I believe, or at least was a board member of GIC, and a very talented economist. He was the chief economist at the Atlanta Fed. once gave a presentation in the middle of the recession when unemployment was high, and unemployment was especially high among prime-age men. He gave a presentation that started with a photograph of Alice Cooper. Now, Christian, I'm sure you have no idea who Alice Cooper is, and probably half the room has no idea who but Alice Cooper is a rock star with lots of hair and very heavy mascara. And he quoted Alice Cooper's song that goes something like this. I ain't got a girl 'cause I ain't got a car. I ain't got a car 'cause I ain't got a job. And what I'm looking for is a girl with a car and a job. My point is that, and this is pure personal opinion, having now been on the outside for a while, that the FOMC, the Federal Reserve, is very effective, I think, communicating generally with the financial market, participants in the financial market. But now that I'm on the outside and I'm trying to observe communication and how it hits sort of the ordinary American, the average citizen, I have more doubts about how effective that is, and that is an area that requires constant work. And it's a little bit of a catch-22 because, you know, they're central bankers after all. You have to be very careful what they say, and part of the initiation is you check your personality at the door when you become a central banker. So that, with methods of reaching the general public, is a really quite an enormous challenge. Let me mention two other implications of this. Financial stability remains, I think, an important focus of policymakers, particularly in this environment, with a low policy rate environment, a low neutral rate, with a search for yield world in which we're operating. It's almost inevitable that there are going to be some distortions that develop over time, and then that's going to bring risks. It's not predicting anything. I'm just saying that the financial stability concern is particularly pertinent in the environment that I described. Finally, I should mention fiscal space. As Charlie very appropriately pointed out, there should be a separation. It's not the Fed's consideration. I think exercising fiscal tools to counter a downturn is a matter of political will. Jason Furman, who was in the Obama White House, has advocated that they legislate in advance certain automatic stabilizers that would be put into place if certain conditions were to develop. I think the chances of that are extremely low. And in Europe, it's a matter of political will. Perhaps there is space, certainly with Germany. But in the United States, under the current circumstances, I don't see that we have a great deal of fiscal space. So let me conclude. I am prepared to believe that this set of circumstances that coalesced after the normalization phase in the last 12 months could very well last a while. I am sympathetic in my reading and understanding of the economy with the view that among the headwinds is a demographic headwind. And a demographic headwind is unlikely to convert to a tailwind quickly. It is simply a matter of time. So it would not at all surprise me if the monetary policy space that the FOMC now enjoys is in fact a fact of life for some period of time. So to reprise and revise Gary Larson's Tyrannosaurus Rex cartoon, we're aging, a recession is inevitable, we're very close to the zero bound, and our central bankers have brains the size of ... I'll leave that as a hanging, hanging point. Fortunately, in fact, they have very large brains, but I think the conditions in which they are actually setting policy require that they be nimble, that they be extremely resourceful, and that communication be very effective. So, thank you so much for your attention. Yes, sir.
Yeah, I don't think my kids hold up 1 second. I look at my children and their age. You came up a different way. You came up a different way. And you're explaining a lot of headwinds demographically going forward 5, 10, 15, 20 years. Based on your opinion, do the generations 10, 15 years younger, 20, 25 years younger, have the bones to be as effective as the Fed was in 2008 and 2009?
You mean the next generation of central bankers?
Yes.
Well, how do I respond to that? I have the utmost respect for the institution, the people the institution attracts, and I certainly I perceive no fall off at all as the leadership has evolved. I thought Ben Bernanke was a truly great man, and I witnessed it firsthand, some of the ideas and resourcefulness and the ability to convince the committee to take certain actions, followed by Janet Yellen, who was equally strong, and she was dealing with a different set of issues. And now Jay Powell, with whom I worked closely for 5 years, but particularly the final 2 years on internal matters, his credentials are different, but I think he's opened up communication and intensified communication, and he stumbled a couple times, but generally has been pretty effective. And I have no doubt that when Jay Powell is ready to move on, that whoever replaces Jay Powell, obviously a presidential appointment, will be up to the task. So I don't see a reason why the next generation is likely to be any less capable. Now, as Charlie mentioned, we lost Paul Volcker this week, and he may stand out as in more ways than one as a giant. He was a physical giant, but he was also a giant in terms of central banking leadership because of the enormous courage that he mustered to deal with inflation and the kind of public reviling that he had to endure, which is unusual, I think, for a central bank chair. Maybe he's a generational kind of lucky happenstance for the United States. If we face those conditions, there's similar conditions again. But the institution attracts outstanding people. I really believe that. And I'm not speaking about or for myself. I'm just saying the institution, top to bottom, is highly dedicated and highly capable people, and no reason to believe that won't continue. Yes.
First, thank you for your service, and Dr. Foster, outside of my interest in capital markets, right, to grow up and participate and benefit in this system. Right, you talk about other countries and where they are, so we're all very fortunate. And not to Monday morning quarterback it, but one thing that comes up a little bit, again, is where all the smart folks at the Fed thought unemployment will get to, and you finally see a lift. And you talked about maybe the economy's not so rate sensitive anymore, but as you think about sort of that math and those conversations you all had, and where unemployment is, any personal thoughts or reasons, rationale, why that may be disconnect relative to where you thought that inflection point would be?
Well, the unemployment picture, that is the level of unemployment, and the job, new job creation has surprised, I think, most people on the committee who had been viewing full employment, and it could be that just beyond full employment, viewing full employment as somewhere between 4 and 4.5%. It's a little bit like the neutral rate. It's unobservable. It's basically based on modeling and theory, how far you think that can go. And I think we've had circumstances that surprised everyone. 3.5% is an enormous surprise. And since it's a good story, not a bad story, I see no reason to beat up the Fed over their miscalculation on that. Actually, one's notion of threshold economic performance indicators is an evolutionary thing. It's always going to be moving. What seems to have happened is that some of the discouraged workers, or a lot of the discouraged workers and people who were not in the workforce for many years and therefore not part of the unemployment calculation, have been enticed back into the workforce. If we can keep this going, this is a very good thing, because there's a lot to be said for just working to keep skills from deteriorating. And so bringing some of these, call them marginal workers, back into the workforce is a good thing for the country long term. No one expected 3.5%. One more question. Kathleen?
President Lockhart, thank you so much for your remarks. You mentioned that economic growth has a headwind, or several headwinds, the structural issues such as aging of the population. Do you think that the Federal Reserve, as well as on the fiscal front, the policy responses are zeroed in much more on the cyclicality rather than on the structural issues? And if so, do you think that there is room here to find policy responses that are more geared to addressing the structural problems or headwinds that the economy is facing?
I very much think that policy making is relatively short-term and cyclical. It's oriented to cyclical response and cyclical conditions. You can't separate cyclical factors and structural factors entirely. But I think Charlie would agree with this, and he commented on it earlier. There are limits to what your tools are and what they can do. And venturing into certain structural questions that have a lot to do with productivity, for example, productivity growth in the economy, or just the long-term tendency, secular trends, is not something the central bank is really set up to do, or has tools to do. If you go back, say, 15 years and look at the United States economy, there have been a number of secular trends. The decline in productivity growth is one. Household formation has declined. Business dynamism has declined, as evidenced by startups and new business formation. These are examples of things that started well before the crisis and continue to this day. I don't see the tool bag of the central bank as being really able much to address those questions. One of the points in my remarks today is simply there is a sober reality that creates an envelope in which Pat and his colleagues are operating, in which they are going to be setting policy. They will do their best, but central banks can't solve some of these structural questions. Thank you so much.